Welcome back to Money Matters. I'm David Kroll from Mortgage Network, and I am standing next to Emily Johnson from Polaris Capital, and we're thinking about the run in the bond market and what it means and how closely it's linked to the recent election. So the first thing that Emily was going to try and explain for us is why the market is segmented at the moment, why portions of the market are doing very, very well indeed, and why other portions of the equity market are doing very much not so well.
Well, interestingly, it's exactly the opposite of what was predicted if we had a Trump victory. So many economists and analysts were expecting that we were going to have an absolute debacle if we ended up with a President-elect Trump, and we're seeing the absolute opposite. Other than at 2 o'clock in the morning on the night of the election, the market's done the absolute opposite by and large. So if you've been watching just the ticker tapes or the headlines, then you're seeing that the Dow and the S&P have been doing quite well for the last 3.5 weeks. It's your old line, blue chip, high dividend yielder, value type companies that have really benefited from this. And there's a lot of reasons why that might be. If you start with the big banks, so the gigantics, the Wells Fargos, the Bank of Americas, the Citis, they've done very well over the last 3.5 weeks. Regional banks have also done well, but sort of at a slower pace, likely to catch up. The reason for that is because of, one, the expectation of higher interest rates, which of course increases the spreads that banks can profit from. Second is because the expectation of an increase in lending due to less regulation. We'll see what happens with that. Then you still have some of the other positive factors, just demographics that are behind us, the need for additional stimulus, et cetera, et cetera. So banks have done very well. Industrials, of course, as David was just saying, with the expectation of many more public works industrials, the companies that supply the materials.
Steel, concrete.
And then everything then the secondary products that those go into, everything, manufacturers, those have done very well based on that expectation. They were probably going to do well, who knows, either way, because both candidates were saying that they expected that we'd see that jump up in public works. So those areas have done well. We're also looking at, in addition to the regional banks, industrials, some technology that hasn't actually done that well. The mainline, the larger technology companies have done well, but by and large, smaller companies in the tech sector, especially immediately after the election, really haven't done all that well. First, we saw mid and small cap, and the definitions of those vary depending on who you're talking to, but think not Coca-Cola, not IBM. Those companies tend to rely more on debt than the larger value-based companies. So because they rely more on debt, and if we have increased interest rates, there's a little bit more pressure on those companies' performance. However, if you have a loosening of lending, those companies also have greater access to capital, which is still relatively cheap, which is not what they would have to then get in the equity markets. So as a result, mid and small cap companies tend to do pretty well just behind the large value names as well. So we saw everything run up for a little while, and now we're definitely seeing a segmentation where we're seeing the blue chips doing really well. Within that, specifically the financials, the industrials, and healthcare. Healthcare has actually been another interesting area. The Secretary of Health that was just announced, and his name is eluding me right this second, but that has actually caused a lot of positive vibes throughout the healthcare industry, specifically around the areas of Obamacare and how that might be changing. Obviously, biotechs have gone bananas, at least for some period of time, and then that sort of carried back a little bit. But we're also investing. Another area that we expect to do well is going to be in natural resources, because once again, if you're looking at greater public works, if you're looking at inflation, any of those things, generalized natural resources, whether you're looking at, and I hate talking about gold, but whether you're looking at gold, other precious metals, or whether you're looking at coffee beans and I don't know, pick it, any of the other natural resources, specifically in North America, we expect that that's going to be another good area to be looking at.
Remember, core to all of this is that this is highly speculative. So by its very nature, this is a reaction to an event, and the substance in that reaction has yet to occur. So this is a bet on the future. The rundown in bond, the value of bonds, the run up in the value of equities, let's move away from nuance at the moment, just the run up and the run down. Those are both based on a series of speculative predictions for the future. Not to be repetitive, this means that there's more risk in the market as well, because if you are not working with a financial advisor, if you're making your own bets, you could improperly believe at the moment that the run-up of 800,000 points in the Dow over the last 3 weeks is money in the bank. Well, what goes up goes down. There's really months and months and maybe a year of hardcore developments that need to take place to justify the run-up.
Which is,
it can't be overemphasized for whoever's watching the program.
Which is probably another reason, again, it's anecdotal, but another reason why some of the value-oriented equities have done well, not just because they have healthier balance sheets, but because they are paying solid dividends.
That's correct.
And so if you have a year that you're going to be sitting and waiting with your investments, you don't want to go ahead and cash in now, you're sitting on a company that still pays you between 2 and 4%, you're going to be more willing to wait that year and see what happens, as opposed to if you're not receiving any dividends, no income. And again, demographics are in favor of that type of investment. The other thing I wanted to jump on that you were talking about is in terms of the value of bonds declining. So we've talked about this before, but if you own individual bonds and you get your statement from Schwab this week and you take a look at it, you're most likely going to see that the value of your individual bonds have gone down. Well, obviously, if you don't sell your bonds right now, it's irrelevant because you're still receiving the same coupon.
That's right.
Same thing, though, is going to be happening if you own funds. So if you see your bond fund, the value of that fund go down, that's obviously because the value of the bonds inside that fund have declined as well. That's a little bit more worrying because you don't own the individual bonds. You actually have a manager there who's deciding which bonds he has to sell. And if you receive your statement and you receive your statement and I receive my statement all at the same time, and I see that my bond fund has declined, and I say I want to sell, and I go into Schwab or the market, wherever I go, and I decide I want to sell my fund, that manager who is controlling all those bonds has to go and liquidate something because I need my money. And if there's enough people that need to do that at one time and you continue to hold your fund, then you're truly left holding the bag of the realized losses that come from those types of funds. So it's really worth taking a look at your funds. And there are several that say balance, there are several that say total return, some of them have bonds, some of them have a variety of closed-end. There's all kinds of things that make up income yielding funds, or income generating funds. So definitely take a look at it and kind of look under the hood a little bit and see what percentage of your funds are actually made up of bonds and what kind of bonds they are, so that you don't get your statement 3 months from now and have a big surprise of, oh, it went way down, way more than if I had actually held just the individual bonds. And I'm not against bonds by any means. It's always good to have diversification, but it's worth taking a look at that for sure.
One more aspect of it all for local viewers: if the general feel in the market, if the speculation in the market remains positive, we're going to see a great deal more of what we're already seeing, which is a tightening of the real estate market and a quicker run-up in prices in the market. The local real estate market is starting to tighten, and the prices are going up, and we have seen no slowdown in purchases in spite of the fact that interest rates have started up. As a matter of fact, the purchase business here on the island looks to be bold and looks as if the spring market is going to be a very hot one.
It's interesting. I've heard the same thing in spite of the hurricane.
In spite of the hurricane, in spite of interest rates going up, basically an expanding economy and a positive outlook, whether or not that outlook is substantiated, gets to the level of people's core needs. The core need in the marketplace, at least as it affects Hilton Head, is for retirees or for potential retirees to get off the stick and retire. So there's this huge buildup of potential retirees in the baby boom market who have been itching and aching to retire. They will now feel a slight impulse, and that's all that's necessary, a slight impulse to do so which translating into a market like our own means instantaneously a tight market and what we experience as a mini boom in real estate here. So this is the first time I've done so, but I'm predicting that the spring market here is going to feel like a boom.
All right, I'm looking forward to it.
All right.
Well, thank you very much for joining us again this week. If you have any ideas, thoughts, issues, concerns, comments, anything, we love hearing from you. Check us out on Facebook. And until next week, this has been Money Matters.